Hey traders, this is Jason from Leavitt Brothers. It is Sunday, June 16th. Hope you're having a good weekend. Happy Father's Day. In today's video, I'm going to take a look at the S&P and then look at a handful of indicator charts. Long term, I think that the charts are still in pretty good shape. Short term, over the last couple weeks, the market has trended down. I guess you can call it like a downtrend, a short-term downtrend within an overall uptrend. Whatever you want to call it, trading for swing traders has been a little bit frustrating because stocks have been all over the place. We've had a lot of gaps. We've had a lot of sudden reversals. The picture isn't really clear in the short term. So I want to look at some charts today, see if I could make some sense of it, see if we can kind of gauge, the odds of a move up, a move down, or what is likely to happen going forward. All right, so let's first start off with just a simple daily S&P chart. This is how I draw it. This is how I draw my trend line. Off the November bottom, obviously this trend line's been hit several times, so it's pretty significant. The trend is in place until it's not in place. I know a lot of people like to predict, what's going to happen, or a bear market is coming and downtrend is coming, blah, blah, blah. But the reality is the trend is up until it's not, and right now it's still up. Looks like we have support somewhere down in the low 1600s. I'm not one to pick an exact level. I think that's kind of silly because the S&P, it could overshoot, undershoot, whatever. So right now I'm just calling support somewhere down in the low 1600s. Moving on, same chart, same trend line. I just added a 50-day moving average. I personally don't use 50-day moving average, but I know a lot of traders do and a lot of institutions do. So it's worth noting that the 50-day moving average is pretty much at the same place as a trend line. In fact, it's about 1613. So this adds to support. Okay, so there's a group of traders out there looking at this trend line saying support's in the low 1600s. There's an entirely different group of traders who look at the moving average and say support's in the low 1600s. So when multiple things line up, it means the support zone is even more significant. Let me throw one more trend line on here. This is right at 1600. Obviously it's a big fat whole number, so that has meaning, but this was 1600 is also, as you can see here, was also resistance back in April, resistance in late April, early May, support down in support a couple weeks ago in June, and then got kind of close last week. Okay, so this adds another layer of support that there's an entirely different group of traders who are looking at 1600 just because it's a big fat whole number and because it has acted as both support and resistance over the last couple months. Okay, so that's what I'm looking at here. If 1600 gets taken out, a lot of people are going to jump on the bears bandwagon. A lot of bulls are going to say that's it. A downtrend is underway. I'm going to get out of here. A lot of bears are going to add to their shorts. But I want to throw one more chart out there just for your consideration. Here it is. I've been trading long enough to know that support levels are not exact. They're not exact numbers where if it's taken out, it's guaranteed that something's going to happen. Oftentimes I see a level get taken out, it overshoots, it undershoots, it spends a couple days down there, and then it reverses hard and just traps everyone. Okay, it'll take out. So in this case, it would take out 1600. Longs would dump their position. Shorts would add to their shorts. Everyone would be on board with like, okay, the market's officially in a downtrend. We're going to trend down throughout the summer, and then a pattern like this, like a rectangle pattern, will form, and once everyone is trapped, boom, blast off, and it'll break out to the upside. I've seen it happen so many times that we have to at least consider it. I'm not predicting that this is going to happen, but just keep this chart in mind that it might happen. If we take out 1600, you want to go short, that's fine, but just keep in mind that you might not be able to stay in the position very long. We might follow through a little bit and then take off to the upside. All right, let's look at a couple indicators now. So here's the S&P 500 versus the NYSE advanced decline line. Obviously, advanced decliners, they bottomed a couple weeks ago. They hit about the same level as they did last November. We got a little bit of a double bottom here, a new higher high. So everything looks good here, but I do want to see advanced decline line expand. Okay, I don't want to see it hang out down here at a low level. I want to see it expand. I want to see it get above zero. And that would tell me that that the bulls still have some strength. If it stays down here, then there's no doubt in my mind that 1600 is going to get taken out. Okay, so I want to see this expand, or else we're probably going south. Here's the S&P 500 on the bottom versus NYSE 52-week highs. Obviously, we've been at a low level for a couple weeks now. I'm perfectly okay with that. There's no, I'm not concerned that as the market pulls back, new highs basically disappear. But if the market moves up here, I'm going to want to see new highs start to expand. Okay, there needs to be some stocks that have held up well enough near their highs that as soon as the market bottoms and starts to move up, those stocks take off, make new highs, and lead the market higher. Okay, so I'm perfectly okay with the movement of the chart right now, but I'm going to want to see new highs expand if the market decides to move up, and if they don't expand, then to me that's a warning. Okay, here's the S&P 500 at the bottom versus a 10-day moving average of the put call ratio. You can pause the video if you want. It's pretty straightforward. Local bottoms, all along the last almost 2 years have coincided with local tops in the put call ratio. So the odds of us putting in a low right here last week, the week before, while this is moving up is pretty low. Okay, so if the market moves up here, I'm going to want to see the 10-day moving average move down. If that doesn't happen, then odds are a move up is not going to have legs. Okay, I want to see the put call ratio move down in order to confirm any type of a move up. So that's what I'll be looking for. Okay, S&P 500 up top versus the average true range on the bottom. This is very concerning. High volatility is characteristic of a topping pattern or a downtrend. It bothers me that the volatility has expanded as much as it has. If the market is going to move up here, I'm going to want to see volatility decline some. It's pretty much as simple as that. Okay, if you look back at the chart, and again, you can pause the video and look at this closer. Each time the volatility expanded, the market pulled back. But soon after, volatility dropped. You can see here in April, we got a volatility topped here and it came down. Back here in early March, it came down. So as the market was topping, basing, whatever you want to call it, and as volatility expanded, no problem, the market corrected, no problem again, but then volatility came back down and the market was able to take off. So if the volatility doesn't come back down here, I'm going to wonder if it's possible for the market to take off. Okay, that's what I'll be looking for. If the market moves up, I want to see volatility come back in. And speaking of volatility, here's the VIX chart. VIX up top, S&P 500 down below. If the current pullback is similar to the last couple pullbacks, the VIX says that a bottom's been put in place. We'll see what happens. It's worth keeping an eye on. Okay, so that's all I have. Overall, I'd say we have a mixed picture here. Okay, the VIX says we have a bottom. The average true range says no, we don't have a bottom because the volatility continues to expand. The put call ratio says no, we don't have a bottom because the put call ratio continues to move up. Advanced decline line is in decent shape. It needs to move up or else that's a warning. New highs, the way it's been acting is fine. It needs to move up. And then of course we have all these trend lines that come in at 1600. So overall, I'd say I'm neutral. Okay, I'm neutral. I know we have support down here in low 1600s. We possibly have another support level down at like 1575. The indicators are not all saying the same thing. I can make a good case for a move up. I can make a good case for a move down. Overall, I'd say don't press. Don't take big chances here. Don't swing for home runs. If you're going to trade, don't expect. You're shooting for singles here. You're shooting for like 3, 4, 5% instead of 10, 15, 20%. Okay. We also have a Fed meeting coming up on Wednesday. That could be a game changer. A lot of people talking about the Fed tapering. So whether the Fed says they are going to taper or not taper, whatever, it actually could move the market a bunch. So overall, I'm neutral. I can argue the market's going to go either way from here, and then with the Fed coming up, that's another reason just to kind of lay low. So that's what I'm doing right now. I'm in the market, but I'm definitely not all in. And that's that. I'll be watching these indicators to see what they say going forward. And for now, you definitely don't want to trade. Right now you definitely don't want to have a really, really strong opinion. Just read the charts, do what they say, and if they're mixed and not sending clear messages, then lay low and wait and have patience and wait for them to clear up. All right. Again, happy Father's Day. Hope you enjoy the rest of your weekend, and I'll see you next time.